Roth is taxed on the front end, traditional is taxed on the back end. But the real question isn't Roth or traditional. The question should be, how much of the account is actually mine? That's your MMA, your my money amount. I'm Scott Grosskreutz with SG Financial. I'm a best-selling author and financial advisor to hundreds of clients across the country, helping people plan more financially smart retirements in the years to come. It's September 2025. And after the Trump administration locked in lower tax rates this summer with the new bill, a lot of people think that Roth versus traditional debate just got simpler. Spoiler alert, it didn't. If anything, the stakes just got so much higher. Because it's not about the tax label on the account. It's about your MMA, your my money amount. How much of it is really yours and how much belongs to Uncle Sam? This decision, Roth versus traditional, can decide whether your retirement feels like freedom or frustration. And the difference comes down to one simple idea: your MMA, your my money amount. By the end of today's episode, you'll know exactly how to use Roth and traditional to protect your MMA and make it work for you. Let's keep it simple. You put $10,000 into Roth, you pay 25% tax up front, invest $7,500, it doubles to $15,000 tax-free. Same growth, same tax rate, same MMA. That's the MMA rule. So what actually makes the difference? The time when your tax rate changes or when strategy creates an edge. That's where the 5 reasons come in. Reason 1, your tax rate will rise. If you're in a low tax bracket today and expect to be in a higher one later, Roth wins. Here's an example. You're early in your career making 50 grand a year, and later you'll be making 150 grand a year. Pay the small tax now, skip the bigger one later. Reason 2, your tax rate will drop. If you're in peak earnings today, doctor, executive, small business owner, your current bracket might be 30%, but in retirement, you only need 80 grand a year, maybe landing you in the 12% tax bracket. Why pay 30 today when you could pay 12 later? Reason 3, maxing out your contribution space. Contribution limits may look equal, but Roth is more valuable. When you put money in a Roth, you're already paying the tax outside the account. That means 100% of the balance in that Roth is actually yours. Put the same amount into traditional and part of it still belongs to the IRS. So if you're already maxing out your 401k or IRA, Roth lets you lock in more MMA, your my money amount, for the future. Reason 4, flexibility in retirement. Degrees of freedom, this is all about control. When you retire, you want a lot of options. Social Security and pensions, usually for most people, fill up your lower brackets first. From there, you can decide, do I pull from traditional and pay little tax, or do I tap into Roth and avoid raising my tax bill or my Medicare premiums? Here's the kicker. If you've got taxable brokerage accounts, you can sell investments with long-term capital gains at very low or sometimes even 0% tax, depending on your income level. By building both Roth and traditional buckets, you can mix and match. That flexibility keeps your taxes low across a 30-year retirement. Reason 5, protection from Congress. Tax laws change whoever's in charge. This year, the Trump administration extended lower tax rates, but that won't last forever. A new Congress or president could raise them, lower them, or change the rules entirely. If all your savings is in traditional, you're fully exposed to whatever Congress sets in the future. But Roth gives you some degree of more certainty. Once you pay the tax, that money is yours, it's locked in. That way, having Roth dollars is like a shield against political swings. You're less exposed, really, no matter who's in power. So here's your MMA truth. At the same tax rate, Roth and traditional are equal. It's about your MMA, your my money amount. And here's why your MMA matters so much. You only get one shot at each year's contribution. The IRS sets strict limits. Your 401k, your IRA, your Roth IRA. Once that year is gone, the window closes. Each year, your income levels adjust. For example, in 2025, the Roth IRA phase out for couples starts at about $250,000 a year. That number changes every year with inflation. So the earlier you map this out, the more tax efficient your retirement will be. For some people, that means starting Roth contributions right away. For others, it's blending Roth and traditional. But the key is, don't wait. These choices compound over decades. If you want help protecting your MMA, your my money amount, visit sgretire.com. We'll show you when to go Roth, when to go traditional, and how to map out a mix that keeps more money in your pocket. not Uncle Sam's. Live your retirement adventure with a plan.